Presents HSBC Global Asset Management. Tushar, good morning. Thank you for joining us. Tushar, it's not looking good. You keep the Nifty aside, but the market is hollow. The slowdown, I think, is a real concern. And whatever optimism which got built in after the political mandate, that simply has faded away.
Yeah, I agree. The economic data which we are seeing so far is not very encouraging. We were waiting for some sort of clarity to emerge on the political side so that the economic reform agenda seems a little clearer. That has come through. However, I think we should give the environment a little bit more time for it to sort itself out, because as you mentioned, things are not all that rosy. There is situations within the economy which lead us to believe that there may be yet some more pain to take before we can signal the white flag or the green flag, whatever flag you wanted to take. But I think the focus has to come back to corporate fundamentals. I think inherent profitability, the upcycle that we have to see, has to come through before we can say that the economy has really turned. But so far, as you mentioned, the critical key parameters are not really showing any upturn yet.
Tushar, given all the continuing concerns around a slowdown, do you feel that we could hear anything from the upcoming budget that would help to allay concerns on that front, that could actually provide some kind of a boost or a fillip and get things going?
Yeah, I think clearly that should be on the agenda. There is the budget, which generally just is a presentation of the government's finances as usual. But I think it's also a very, very large policy statement and a sentiment which clearly everybody waits to hear. I think this could be the time that the government needs to kind of allay these fears in some way, show that they are willing to take the hard task ahead of them, and present something which will be of some hope to the overall community. There seems to be a concerted effort. I believe there has been a lot of discussions with the government prior to the budget, and there's been a lot of discussion and debate in terms of what should go in as recommendations and what the government should be able to do. I think these are all very positive signs. I think the government continues to keep their ears open, eyes open. I think, of course, one should also take that with a pinch of salt, saying that there is as much that the government can do. There is something else that the economy, the corporate world has to respond to as well. And given the situation currently where there is a lack of demand, the discretionary side of the picture is looking pretty weak. All of that seems to be something which the government clearly can take a little bit of view on. And we are all anticipating something which should point us to the right direction to kind of give the economy a little bit of fillip. I will halt myself to say that maybe there will not be a stimulus, but there seems to be largely across the world, the word which is going around is stimulus. People are making cash available to their economies. I think this lack of growth is being visible across the world. And I think India could also follow in that line as well. So we are all hopeful.
Okay. Tushar, hi, good morning. So as an investor, what is it that you do when you're awaiting such key global as well as domestic cues? Do you buy this consumption slowdown in hope and anticipation that there would be some stimulus perhaps, or the animal spirits would come back, maybe not now, maybe 6 months down the line?
Yeah, I think that's a very interesting question, because animal spirits, being animals, spirits, they don't really give you enough advance notice. So I think the question should be that how long do we all think that this is going to last? If you look at cycles, typically these cycles range from between 2 to 3 years. We've had the last 3 years of pretty significant slow growth that has accumulated, and the hope was that this coincides with a political mandate which is positive and that the cycle turns. That was the hope. At the moment, it doesn't seem to translate instantly into some sort of economic activity. So I think we have to wait and watch. But coming back to your question to say that how should investors view it, I think it depends on the term of the investment horizon. If the horizon is, as equities would warrant, a longer term horizon, upwards of 3, 4, 5 years, then I think this is the time to start selectively coming into the market, because clearly there is a lot of depression, a lot of lack of enthusiasm, and I think those are the right times to invest. Many times people conversely look at the valuation picture and say, well, it's not really reflecting in the valuation so far. But I think that's another story. I think we clearly have a two-tier market. The headline index is driven by a few stocks which have taken the index to where they are. But if you take the large majority of stocks across even the large cap spectrum, there are a lot of companies which are trading well below their average prices for the last 3 years at least. So which means there is significant value, and we are all waiting for an upturn in the economy to make that value visible. But as long as the impression remains that profitability is going to be under pressure, then these valuations are not going to adjust automatically. But if you have a longer term view, I think this is probably the time to get into a diversified portfolio. I think that's probably the best thing that an investor could do. However, on the other side, if the term of horizon, as I talk about, is much lesser, I think there is yet a lot of uncertainty for us to kind of undergo before it will be safe to go in. Again, I will say that if we wait for the numbers to change, by the time the market would have adjusted automatically. So one shouldn't wait for the numbers to actually come to decide to enter. One should take a call depending on our own ability to wait it out. And if one thinks that the term is long enough, then today is as good a day to enter.
Now, last 5, 6, 7 years, we've not seen revival in the Capex cycle. But the consumption engine was humming along very nicely, very smoothly, which kept us going. My personal view is that I don't think a lot of corporates have a balance sheet to start committing to Capex. Consumption is slowing down. So are we staring at a double squeeze for the economy, where Capex, which was supposed to revive a couple of years ago, has not revived and may not revive in a very linear manner, and consumption, which was keeping this economy afloat, for the first time is threatening to slow down substantially. So are we staring at really bad, ugly days, and rather than hoping for a better turn, you think one right now needs to fasten their seatbelt because the slowdown is going to be a painful one?
Yeah, I think that's a very complex question. So allow me to kind of elaborate a little bit, because typically what tends to happen is Capex comes at a time when either there is an extra demand, which means that you are hitting the capacity utilization of your current capacity, and now you realize that to kind of ensure that your market share continues to remain in a growing market, you start investing in capacity. Clearly, this is not the time for any of that. So to say that the corporate should invest right now just because they have to, I think that's not a very logical answer to come to. So clearly the environment doesn't allow you to go into Capex because you are hitting capacity utilization. The other time that many corporates start to invest in capacity is times like these, when there is lack of demand and you are now thinking 3, 4, 5 years into the future. And to say that maybe at this time, if interest rates are low enough, liquidity is available, then let me expand capacity right now when there is no significant demand, so that I procure capital at a cheaper cost and build capacity just for the time that the demand will come. So there's a lot of pre-thinking in terms of knowing when to do the Capex. I think this could be one of those times. But in the past, we have seen that lack of demand was coinciding with higher interest rates, and it was difficult for corporates to access these markets. Today, I think one of the better things that has emerged is, of course, the interest rates have started to come down, which means if they think like that, then there is at least this capacity, this availability of cheaper capital available. Having said that, I think the realistic picture is that not all corporates have access to cheaper capital today. There is clearly now again a two-tier market where companies which are much more secure clearly have access to credit markets, but companies down the capital curve, and especially at the lower end, especially with what's happening to the NBFCs, the ability for these companies to invest now is really hampered because of the lack of credit available. So I think if this whole picture has to change, I think the signal has to be lower interest rates and easy access to credit. I think these are the two factors which ensure that a Capex cycle could start. Clearly, we're not seeing a Capex cycle starting because of demand. So I think the other two things have to happen. before we start to see a capex cycle. So I hope that makes it a little clearer.
We hope so too, and we hope that it happens sooner than later. Tushar, great to have you on the show as always. Thanks so much.
Thank you very much.